The Big Ten Conference has long been the industry leader in controversial ideas, and it looks like another one might be on the horizon, a private capital deal. The nation's wealthiest athletic conference, always looking for ways to monetize college sports, is reportedly exploring a private investment arrangement that could bring in $2 billion or more for the league and its 18 member schools. Commissioner Tony Petitti is leading discussions with private equity firms, and the proposal could include a 10-year extension of the league's grant of rights agreements through 2046 and a tiered distribution of new revenue. That combination could bind the conference together while widening the gap between the top programs and the rest. While it might prevent a long-theorized Super League, it could also further limit which schools can compete at the highest level. Sources say the concept has been discussed for months, and there's no consensus. Most schools reportedly support it, but heavyweights like Ohio State and Michigan are still debating. One Michigan regent publicly opposed the plan, saying selling university assets would betray students and taxpayers. To get top programs on board, the Big Ten might create unequal revenue splits, giving the biggest names more than the smaller programs. Uneven payouts have a history of fracturing conferences, as seen in the Big 12 and ACC. But in the modern college sports landscape, equal partnerships are increasingly rare. The lure of immediate cash, potentially $100 million or more per school, is especially tempting for programs in the lower tiers, who also face rising costs, from facility upgrades to athlete settlement obligations. Yet private capital isn't free money. A new partner would naturally look to protect its investment, potentially influencing how the conference operates. The Big Ten already has a powerful partner in Fox, heavily involved in expansion decisions. Adding another voice with billions at stake could change the dynamics further. Other leagues, like the SEC and Big 12, have approached private capital cautiously, and some schools have cooled on the idea. Still, many in the business of college sports see private equity as inevitable. Inefficient markets and growing financial pressures make it attractive for investors and potentially lucrative for schools if structured well. Ultimately, the Big Ten's plan highlights the tension between money and mission in modern college sports. With the arms race for facilities and settlements like the House case, borrowing billions may seem like a quick fix. But as former Nebraska athletic director Trev Alberts noted, the problem isn't revenue, it's spending. Turning to private capital might add funds, but it doesn't solve the underlying issues, and the cost of those billions may come with strings attached, shaping the future of the league for decades.